Welcome. I don't know about where you happen to be, but it's snowing here in Illinois, and not necessarily out of the ordinary entirely, but unusual nonetheless. We're going to talk today about CARES Act, the CARES Act, non-loan benefits of the CARES Act for businesses. But before I do that, I do want to get into some loan aspects, and I'll get to those really quickly. I do want to say up front, a thank you to the Alliance Collaborative for having us again cooperate and work together. It's been a great relationship that we've had in putting together these 4 webinars. There's one coming up this Thursday on the world after COVID-19, planning for business continuity and the return to normalcy. And then also, although not with the Alliance Collaborative, Signs of the Times has requested that I participate in a webinar on a misspelled word, April 20th, on Monday, regarding the FFCRA, the Family First Coronavirus Response Act. This webinar is going to follow the format of some of the others. We are going to have an interactive portion later. I'm going to basically go through the presentation. Please feel free to answer or ask any questions. If you have thoughts as an answer to a question that somebody else raises because I've mentioned it, please let me know and share that. This should be interactive. Submit questions. We will follow with the Q&A session at the end, and I will try to answer as many questions as possible. Finally, when you leave, we request that you take a survey and be sure to register to the upcoming webinars. Disclaimer, this is not legal or accounting advice. Nothing can replace the direct counsel that you could receive from an attorney and an accountant. So we recommend that if you have any questions that you get that direct counsel, because I can't know your particular individual situations. That being said, we are going to move forward and try to get through a lot today very quickly. Please let me know if you have any questions as we go on. So the last time that we spoke, if you were a part of the webinar last week, we had 2. The first on Tuesday was talking about the loans under the CARES Act, particularly the Paycheck Protection Program. And then Thursday was focused on employees. I'm going to return to the PPP loan for a moment and the forgiveness part of it, because in the webinar before, I didn't really understand a particular section, and I thought that it was poorly written. I still think that, but I have figured out, and I want to share that with you because I think it's a significant aspect. And so if you have applied or you are going to apply for the Paycheck Protection Program, I want you to know this so that you can plan it out. So the amount of the loan can be up to your payroll costs times 2.5. But what are payroll costs? Well, we have retirement benefits, state or local taxes, vacation, parental, family medical or sick leave, salary, wages, commissions, similar items, cash tips or the equivalent, group health benefits, allowance for dismissal or separation, and you would not, for a sole proprietor where it's not over $100,000. So that is what it does include. What it does not include are your employee principal for any income for an employee where their principal place of business or residence is outside the U.S., compensation in excess of an annual salary equivalent of more than $100,000. So if somebody's making $150,000, you exclude annually, you would exclude 50,000 and then divide by 12 so that you'd get the monthly portion of that. Leave paid under the FFCRA, taxes under Chapter 21, which is Social Security and Disability, taxes imposed under Chapter 22, and that's really the railroad retirement tax, and then taxes imposed or withheld under Chapter 21 for more or less FICA hospital 1.45, and your federal tax withholding for the employer. So in other words, as we've said before, you are not going to get credit for money that you would be paying the federal government anyway. So, all right, PPP loans revisited. The foregoing, the costs minus the unallowed costs are your payroll costs. The maximum payroll loan is the average monthly payroll costs over the last year times 2.5 plus any outstanding amount of a B2 loan made between January 31st and the date, particular date. And we're not going to get into that right now. So a loan made under B2 this year, you could add on to that and kind of refinance. The average monthly over the last year for some with particular circumstances, it might be different. But let's just say we've got a monthly, we have a monthly payroll cost as we've defined it. The costs allowable minus those that are not, we have our payroll costs. So the maximum payroll loan is 2.5. Your monthly average payroll costs cannot exceed $10 million, but the maximum loan forgiveness is different. So this is what I wanted to get into. The maximum loan forgiveness period is the allowable expenses for 8 weeks versus 10 weeks for the 10 weeks for the maximum payroll loan. So you're applying for 2.5 months worth of your payroll expenses, okay? You're only going to be forgiven 8 weeks of that. So you've already lost 2 weeks that you're not going to be forgiven. So you need to be strategizing on what you're going to be applying for. And let me say, the forgiveness part is not guaranteed. You still need to apply for it. So again, the point here, maximum payroll loan is 2.5, the monthly average payroll cost, that's 10 weeks. Maximum loan forgiveness period is the allowable expenses for 8 weeks. Allowable expenses are different than what I just talked about. I'm getting to that now. So the allowable expenses means your payroll costs, your employee salaries, commissions, or similar compensation, group health benefit costs, interest on other debt incurred prior to February 15th, payments on interest on mortgage, loan or mortgage obligations, rent, and utility. Now let me go back to this for a moment. These are your allowable expenses, what you can use the PPP for, but they are not what your payroll costs are, because it's including more than what your payroll costs are, and it's not going to be what you can use the loan or what the forgiveness will be. So we have allowable expenses. Maximum loan forgiveness period is allowable expenses for 8 weeks. That's the period. Focus on the 8 weeks here. The maximum loan forgiveness is not all allowable expenses multiplied by weight. I want to point this out. The allowable expenses is not the basis for forgivable expenses. Forgivable expenses are your payroll costs, mortgage interest, rent, and utilities. Those are the only aspects that you can actually have forgiven under the PPP. Everybody's talking about, get a loan, get the PPP, it's going to be forgiven. Well, one, again, you're getting 2.5 times your payroll costs up to a certain amount. So that's already 10 weeks. You're going to only be able to get forgiven 8 weeks. And then within that, the 8 weeks, there's only these: payroll costs, mortgage interest, rent, and utilities. Now, the allowable expenses means this is what you could spend the loan on: payroll costs, employee salaries and commissions, costs, group health benefits, payment on interest and mortgage obligations, rent, and utilities. The forgivable expenses means payroll costs, payments of interest on mortgage obligations, rent, and utilities. Now, allowable expenses, you had the interest on other debt occurred, but forgivable expenses, that's gone. So we're limited to these over here. Now, payroll costs, as you may remember, included all of these things here, and we're not going to go through each of them because I've done the work for you. The allowable expenses means comparing what payroll costs are under the definition and what the forgivable expenses are. Most of the allowable expenses are allowed, or forgivable, that is. The interest on pre-existing obligations is not. Interest on mortgage obligations is. So you just want to be aware of that. This is the part that was a little troubling before. The amount of the loan forgiveness under this section shall be reduced by not increase. So, all right, let me take a step back. So the PPP, we've talked about how it's 8 weeks, not 10, that can be forgiven. We've talked about how they're forgivable expenses, not necessarily your allowable expenses. So you can spend money on some things, but not get it forgiven. Now, there we have the forgivable expenses. However, it can be reduced. The amount of the loan forgiveness shall be reduced, but not increased, by multiplying the amount described in subsection B, which is, let's say, what I told you, what could be forgivable: payroll, mortgage interest, rent, utilities, by the quotient obtained by dividing the average number of full-time employees you had during that period, that 8-week period, by, at the election of the borrower, employees from the past. And you can look at the section to determine how many that is. Now, the key here was, I thought before I was reading it that the amount of the loan forgiveness shall be reduced by this amount, by the amount you obtain, multiplying the costs that you want to deduct by this ratio, which, if you have the same number of employees, would be 1. And then if you subtract that amount from the payroll costs that you're trying to get, or the forgivable costs, you'd end up not being able to forgive anything. So I was misreading that, concerned about the language. I figured it out. It's not reducing it by the amount, it is reducing it by the method. So forgivable expenses times the number of employees during the covered period divided by the number of employees that you had before. So the average, and here are the options you can choose later. In the case of an eligible, so I'm going to skip over that. Forgivable expenses, remember, 8 weeks times the number of employees covered period over, let's just say, from February 15th to June 30th, 2019. That's the period that I'm using. Doing the math, let's say that they're the same. The forgivable expenses times 1. The forgivable amount equals the forgivable expenses times 1. So the forgivable amount is that whole amount for the 8 weeks. Now, let's do it a little bit differently. The forgivable expenses, remember, we're looking at 8 weeks, times, I have 8 employees now, and I had 4 before. I've doubled my employees. What happens? Well, that turns out to be 2, but you remember it said that the amount of the forgiveness shall be reduced, but not increased. So right here, by multiplying the amount. But we basically need to convert that not increase to a 1, so the forgivable amount, again, equals the forgivable expenses. Forgivable expenses, let's do the opposite. I've got 8 now, I had 16 during that period. What happens? Well, 8 divided by 16 is 0.5, multiplied by forgivable expenses. Let's say it's $100,000. 0.5 times $100,000 is $50,000. So the forgivable amount is $50,000. I've reduced my forgivable expenses, 5.5, which is the ratio, 8 employees divided by 16.5. And so I've cut my forgivable amount in half. So you want to be aware of that. It can be reduced by the reduction in employee numbers. It can be reduced by reduction in salary or wages exceeding 25% cut. So if somebody was making 50,000, or let's make it easy, 80,000, and you cut their salary down to 50, your forgivable expenses are going to be reduced because you've actually reduced it by more than 25%. 25% of 80,000 would be 60,000. And for this purpose, you're not including employees that make over 100,000. Now, there is an exception here, although you're only looking at the 8-week period from the date the loan originates. From the date your loan originates is where your 8-week period is starting, okay? It's not like pick and choose which 8 weeks you want. Once you get that loan, your 8-week period starts. So you want to do the math, and you want to be careful, and you want to be maximizing the forgivable amount. You don't want to be paying it from things that, you know, don't pay down your credit card debt. You can, if it was before February, but you're not going to get that forgiven. So now we talked about how if there is a reduction in salary, reduction in employees that hurts you, that reduces the forgivable amount, you can remedy that as long as they are rehired and sufficient pay is by June 30th. So remember, allowable expenses is near, but not all the forgivable expenses, or reverse that. The forgivable expenses is near, but not all of the allowable expenses. If your employee is less than during 8 weeks after the loan, so if you have less employees than you did before, the full amount is not forgivable. If your pay is less during those 8 weeks, the full amount is not forgivable unless you remedy that by June. I know that went through that really quick. I apologize, but I wanted to clarify that so that anybody that's listening, getting a loan, planning what they're going to use it for, plan it wisely and can maximize what they're wanting to forgive. Now, we've got to move on to non-loan matters. The CARES Act provides a number of features. They provide a lot of funding and information for small business development centers, women resource centers, minority business development centers. Look in your local area. These places, these organizations get funding through the SBA, or rather through the CARES Act, to help support small businesses and guide them through these times, COVID-19 related matters. So think about that, use those, find out where they are. For example, Women's Business Center program, also matching funds requirement for assistance waived for a 3-month period. Also, state short-time compensation programs. So basically, this is a situation where for businesses that can elect to have a short-time compensation. So what does this mean? It basically is set up so that an employer, small business, can work with the government to get funding rather than laying off people, reducing the hours, so short time. So there's the CARES Act provides for rapid response advisory teams to advise businesses on alternatives to layoffs. Also provides education and assistance to employers to assess the feasibility of participating in that program. Reduces the hours in lieu of layoffs. Basically, if somebody was working 40 hours, they can go down to maybe 30 hours. So that's what this program is. And it's still possible for the employees to be eligible for unemployment even while on this program. So that's another one to look for, is the short time program. Grants also are where somebody may have received a grant under the Small Business Act for a foreign trade mission or trade show exhibition. These grants that you may have received will be reimbursed if you had to cancel those trips or trade shows due to COVID-19. So if this isn't applying for a grant, this is if you already received an SBA grant for foreign trade mission or trade show exhibition and you can't go or had to cancel it, you can get reimbursed the grant. It does provide for bankruptcy relief. Payments made pursuant to a federal COVID-19 law. So if you receive COVID-19 related funds, are not treated as monthly income for bankruptcy. Let's say you're filed Chapter 11, which is reorganization, and you might have to look at the income, or you're going to qualify, look at the monthly income. Payments made pursuant to the CARES Act or any federal COVID-19 law are not treated as monthly income for 1 year following the enactment. You have to, if you're already on a bankruptcy plan, you can request a modification of that plan during these circumstances. Employee retention, that's what a lot of this is for, right? It's to help us retain our employees. It's to help small businesses keep people in the workforce, keep money in the economy, and moving around. If you're an employer that was in a trade or business in 2020 and in any other calendar quarter, fully or partially suspended your operations due to government orders, or 50% less, your gross receipts are 50% less from the prior year, you can get an employee retention credit. But again, this credit right here is only for those that were in a business in 2020 and in any calendar quarter, you fully or partially suspended your operations due to government orders relating to COVID-19, or your gross receipts for that quarter were 50% less than, or more than 50% less than what they were in the prior year's quarter. You can get a credit against the applicable employment taxes in an amount equal to 50% of the qualified wages for each employee during that quarter where the wages are not exceeding $10,000. You can't exceed the amount of the employment taxes due. So if you have 10,000 employment taxes due, you don't get a credit for above that and get more of a refund. But nonetheless, any excess would be treated as an overpayment and refunded to you. You can't double count an employee or double benefit here. You can't get funds, let's say, from a PPP loan to be paying for somebody and get the retention credit. So watch that. You can't double count. And pretty much on anything related to government programs, just as a general concept, don't double dip. If you're counting the same number twice, there's probably an error. But anyway, here, don't double count the employees or double benefits here. If you are getting two different benefits for the same thing, be careful. Accounts for wages paid between March 12th, 2020 and January 1st of 2021. And you are not eligible for the credit if you receive the 7A PPP loan, which makes sense. I just said you can't double dip, right? All right, employer deferral of employment taxes. Not eligible for credit if you are in the 7A PPP loan forgiven. So you're not eligible for the credit if the indebtedness of the 7A PPP loan is forgiven. If you get a 7A PPP loan, you can still apply for the credit for deferral of employment taxes, but not if you have that loan, that portion of the loan forgiven. Employer deferral of employment taxes. If you qualify, you can defer employment taxes through December 31st, 2020. So the employment taxes that you would otherwise have to pay for the period through December 31st of this year, you have until December 31st of next year to pay half, 50% of them. So you can defer 50% of the employment taxes until next year. You're having to pay 50% here. And any kind of remainder beyond the 50% December 31st of the following year, if there is a carryover amount. Adjustments on net operating loss. And please feel free to ask any questions, at least when a question comes in. I know that there's a world out there. Adjustments on net operating loss. Here's a copy of the existing statute now. Let's talk about net operating loss. Now, obviously, this is talking about a loss. And so if you have a net profit at the end of the year, this wouldn't necessarily apply. But many businesses might go and have a net loss. So that's what we're talking about. There shall be allowed as a deduction for the taxable year an amount equal to the lesser of, this is what it reads right now. This is the existing statute. The aggregate of the net operating loss carryovers to such year plus the net operating loss carrybacks to such year, or 80%, you get the picture. I want to focus on an amount equal to the lesser of, and then these two options. Because the statute, the CARES Act, amends what we just read by striking an amount equal to and everything that follows. So the lesser, right? If we go back, we're getting rid of an amount equal to the lesser in all of this. So what does it do? It makes it an amount equal to, and all that follows, and inserting this, an amount equal to, in the case of a taxable year beginning, sorry about that, beginning before January 1st, 2021, the aggregate of the net operating loss carryovers to such year plus the net operating loss carrybacks to such year. Now, it sounds the same, but it's different. There's not a choice of the lesser of the two. This is what it will be. So for a tax year beginning before January 1st, 2021, it's the aggregate that we just read. And for a case of a taxable year beginning after December 31st, then there's another provision. Another part that I want to talk about is the limit. Now, this is the existing statute. You can tell the difference. This is a statute with the numbers on the side is the CARES Act. I guess at this point, they're both statutes, but you understand what I'm trying to get at. So the amount of carrybacks, the entire amount of the net operating loss for any taxable year shall be carried to the earliest of the taxable years, so on. The taxable income for any such prior taxable year shall, let's look at C, not exceed the amount determined under subsection A2 for such prior tax year, right? The taxable income for any such prior taxable year shall not exceed the amount determined under the prior section that we were looking at. So basically, it was limiting the amount that you were going to be able to carry or use as a net operating loss. Now, CARES Act amends that. So for taxable years beginning after December 31st, 2020, be reduced by 20% of the excess. So basically what that's eliminated is the taxable income for figuring this, so, all right, take a step back. So 80% of the taxable income computed. Do you see that here? So there shall be allowed as a deduction for the taxable year an amount equal to the lesser of. This talks about net operating loss, carrybacks, carryovers, or 80% of the taxable income computed. Now, we've obviously amended that, so now it's changed. And now here, this is the old one where it was talking about the taxable income related to that provision above. We're amending C, so it's no longer going to say not exceed the amount. And it's just saying that the taxable taxable income for any such prior tax year shall A, B, and now C for taxable years beginning be reduced after 2020 be reduced by 20%. So it eliminated that cap. It applies to losses in 2018, 2019, 2020. The net loss carryback can be applied to each of the 5 taxable years preceding the taxable year of such loss. So in essence, it dropped the lesser of that choice and allows the aggregate without, it's just allowing the aggregate for that period of time. So you add in the net operating loss that you may have, the carrybacks, carry forwards, and eliminated the cap under 172 BC. Going back again, and this is where I am not a tax attorney, so I highly suggest you talk to your accountant on that. So again, it's the net, it's not making it the lesser of, it just is for a taxable year beginning before January 1st, 2021, the aggregate of the net operating loss carryovers and the net operating loss carrybacks. And then it's also eliminated the cap. Talk to your accountant, but remember, these are net operating losses. So if you have a net profit, then that was not necessarily applicable. Well, it wasn't applicable to. There's also a credit for prior year minimum tax liability. It's applicable to tax years after 2017. Talk to your accountant. You do have to apply for the refund on this. So we all probably have heard of the alternative minimum tax, not only perhaps for some individuals, but for businesses. And so this is a credit for where that might have come into play. Applicable to tax years after 2017, you can apply if this benefits you for a refund. So talk to your accountant again. Changes in business interests for 2019 and 2020. The general rule is there shall be allowed as a deduction all interest paid or accrued within the taxable year on indebtedness. Now remember, in most everything, like even in the CARES Act, the provision regarding the forgivable amounts, it says the following expenses shall be forgiven, period. That's 1102, and then you have to wait to 1106 or 1107 until we start talking about the reduction in the amount of the forgiveness. So if you read only the first provision and stopped, you wouldn't get to that latter provision and know that amount can be reduced. The amount of forgiveness can be reduced in certain circumstances. Likewise here, just because you read something and it says there should be allowed as a deduction all interest paid or accrued within the taxable year on indebtedness, there's always going to be a limit, right? So we look to the limit, and that is in J. Here we have A, the general rule, but then after you get down to J, limitation on business interest. And that limitation on business interest is the amount allowed as a deduction under this chapter for any taxable year for business interest shall not exceed the sum of, this is what it reads right now, the business interest income of such taxpayer for such taxable year, 30% of the adjusted taxable income of such taxpayer for a taxable year, plus, now here's where the change came in. So it's not exceeding, the amount allowed as a deduction would not exceed the sum of these added. And I apologize for the slides keep going up. That's not what was my intention was. The intention here in particular was to just have that 30 change to a 50. This is where the change under the CARES Act came in on business interest for 2019 and 2020. So it increased the amount that's allowed by increasing the 30% of adjustable taxable income to 50% of the adjustable taxable income. So this again is the calculation and determining the maximum amount of business interest that you can deduct. And you can elect to use, so where it says 50% of the adjusted taxable income of such taxpayer for such taxable year, the plus just ... for the moment. What I'm telling you is that this also allows you to use the 2019 adjusted taxable income for this, determining this limit. So what does that mean? It means that if your adjusted taxable income was higher in 2019, you're going to want to use 2019 to calculate the limit on the interest, right? Because remember, the amount allowed as a deduction under A for interest for any taxable year for business interest shall not exceed the sum of the business interest income of such taxpayer for such taxable year, plus, this is the 50 that the CARES Act amended, 50% of the adjusted taxable income of such taxpayer. So what we're wanting to do is get under J1 this amount high as possible. How do we do that? We use the highest possible adjusted taxable income. And if that's 2019 over 2020, then you get to use 2019 adjusted taxable income for that calculation. Turning to charitable contributions, for a corporation, the CARES Act provides for a deduction of qualifying contributions so long as the total qualifying cash contributions does not exceed the excess of 25% of the company's taxable income. So you take your taxable income. Now we're back to 2020. This is not like the one I just talked about. This is 2020, for example. 25% of your taxable income. Let's say our taxable income is $100,000. 25% of that, $25,000 over all other charitable contributions. So if our charitable contributions were 10,000, 25,000 over 10 would allow us 15%. So in other words, your charitable contributions cannot exceed 25% of your taxable income. And that is an increase. And you have to elect to obtain this deduction. The contributions that we're talking about here are must be in cash and COVID-19 related. Educational assistance. An employer can deduct payments made on an employee's student loan interest or principal. So if you make payments to an employee's loan interest on a loan, student loan, or principal, you can deduct that, but it has to be part of a written educational assistance plan. And you would need to have that established. So if you don't already, you'd want to talk to your attorney about the drafting of that and whether you can draft one now and have it apply. But it also is limited in that you can't do that for like an owner of the company or over somebody that makes over a certain amount of money. FFCRA, Families First Coronavirus Response Act. This is not necessarily part of the CARES Act, but the CARES Act does amend the FFCRA, and this the FFCRA applies through December 31st. Remember that part of the FFCRA provides for paid leave, where somebody has to not be employed, somebody has to have leave because they are suffering symptoms that are similar to COVID-19 and they're seeking a diagnosis. If they are with COVID-19 and they're in quarantine, as they should be, or if somebody is taking care of a child that is not in school or daycare because of COVID-19, those are situations where you, the employer, have to pay for the leave under the FFCRA. But the CARES Act came in and did provide some limits on the amounts that would be applicable. Check with those amounts, and for your information, that webinar on Monday, this coming Monday, there's a link later and I'll set that up. But that's going to talk about the FFCRA provisions more in detail. Employee less than 30 days, but 30 within the last 60. You're saying, what the heck does he mean by that? That makes no sense. So for a lot of the provisions here on the paid leave and limitations, it applies to applies to employees that have been working with you for at least 30 days. But it doesn't necessarily, in certain circumstances, need to be 30 days continuously. So if somebody has worked for you for 30 days within the last 60 days, then that qualifies as an employee that's worked for you in the last 30 days. That's what I mean by that. You also, under the FFCRA, CARES Act provides for advance refund of certain credits. Be careful about the anti-discrimination aspects of these acts and in this situation. We all are contributing to being a better society. I know it's frustrating. I know you probably have a business that may be impacted one way or the other, but we're all doing our share to get us the whole economy back to healthy, get everybody back to health that can be, and let's eliminate the number of people that pass due to this. And the way that we do that, in my mind, is shelter in place. And as boring as it may be at home after several weeks, or as frustrating as it may be, with everybody at their throats in the household at times, we're all doing our part, and employers, you're suffering, but you got to do your part too. And we've got to be careful that we don't discriminate or penalize somebody for taking leave during this time. Personally, I don't even care. This is somewhat advice. I'm just suggesting that you be very careful about penalizing anybody taking leave, whether it's FFCRA, COVID related, or they just say that they need to take care of a loved one. Just be very careful. FFCRA, you definitely cannot penalize anybody for taking leave under the FFCRA, but then you also have the Family Paid Medical Leave Act, right? So anybody taking leave during this time that they're eligible for, or that the statute provides for, you can't discriminate, you can't penalize. What we want to do as employers is make sure that they know that that you're behind them and appreciate who they are, and that they come back. I will have to say, I made in passing that everybody's at their throats in the household. I personally have found that it's kind of forced us to sit as a family and play games. We played Game of Thrones, Monopoly. We've got another game that we've just had over in the bookshelf set up. So take advantage of these opportunities, because if you are like me out there and have kids that are in high school or junior high, it's getting near the point where those days are not going to be as often. Take advantage of the opportunity, see the positive in it. Substance abuse disorder. There are also provisions in there that you do not discriminate if you learn through inadvertently or otherwise that somebody has substance abuse disorder. So just be mindful, talk with your attorney. But a way of is just, don't discriminate on anybody in employment decisions. If they do a bad job, that's one thing. Anything else, be cautious or don't do it. Other items of note here is just kind of a list that we're going to shoot through. If you are That's not if you are into alcohol, that's if you are in the alcohol business. There's an excise tax modification for hand sanitizers. You may have read that a number of companies that are otherwise distillers are moving into the hand sanitizer at the moment. If you're in the healthcare industry, there are many, many additional sections under the CARES Act, and we could do a whole webinar or several webinars just on that. There are grants for various aspects. There's telehealth provisions, pharmaceutical incentives, and items for companies talking about zoonotic drugs, animal drugs, geriatrics, the nursing workforce. If although, you know, with the Alliance Collaborative, this has been targeted not necessarily particularly to employers in the challenge course industry, but that is an audience segment here that I'm quite aware of. But nonetheless, if you happen to be a business in any of these other areas or have a tangential aspect, excuse me, you may want to look into what opportunities there might be to pivot into a certain situation. There are additional loans to air carriers, cargo air carriers, businesses critical to national security, and some other additional funds to businesses where other resources might not be available. What's interesting here is that where a lot of the other provisions under the CARES Act, talking about the PPP, talking about, you know, the where it's the amount that you can exclude or include in your payroll costs and so forth, that uses the number of 100,000 per year. There are limitations with respect to the provisions on air carriers and this particular aspect where they're talking about officers or people involved with the company making over $425,000. If you're in education or you have those in education, such as children, there are also many provisions in here related to Pell Grants, student loan interest, you know, deferments, work study programs. So that's not related to you as an employer or a small business, but it may be in terms of your own family or your employees. Again, there are lots of other smaller items, just as a kind of quiz. I mean, I would say that I didn't read every word of the 880 pages, but I read a lot of it. And yes, over-the-counter menstrual products shall now be included as paid-for medical care. So where there may have been a provision in certain plans where that was not a covered expense, it is a covered expense now. So I've reached about the time that we need to circle back to the disclaimer. And that basically means that Mudd Law, even though Mudd Law is a law firm and I am an attorney, I'm not giving you specific directed personal legal advice reaching through the screen. The Alliance Collaborative, a wonderful organization to help support those in the challenge course industry. They are not attorneys providing accounting or legal advice here, accountants providing accounting advice or lawyers providing legal advice. So our disclaimer is that this information is as a resource, and do with it what you can, but you need to take it and go talk to your individual attorney and accountant. And a lot of the aspects that I talked about today, the IRS code and all of that, crazy statutes, and you need to look at the statute and the CARES Act and the amendments and the changes and so forth. And if you go to Cornell online, you know, you can Google a particular statute, and Cornell has a great database of all federal statutes. but they have not yet updated this necessarily. So for example, in preparing for this webinar, the slides with the quotes from the existing statute prior to CARES is what's still online. So be careful what statute you're reading online to kind of parse those together. So anyway, that's our disclaimer. You can go to the alliancecollaborative.com COVID-19 // COVID-19. I know that the Alliance Collaborative has a number of resources there for the people in that particular industry related to other organizations and so forth. Our Mud Laws page is at COVID-19mudlaw.com. Questions and comments. We do have a question. What is my bullet pointed punch list of people that I should consult with when making business decisions related to the CARES Act and navigating this new environment? How do I know when I should be making decisions myself and when I should be leaning on my professional service providers? That's a really good question. And I'm going to give you the lawyers or attorneys. I like attorney more than lawyer. I don't know why, but it's just my preference. They both mean the same thing. But the attorney's answer, and then I'll tell you my personal answer. The attorney answer is you should always consult an attorney or an accountant with any question that you may have relating to the law or your accounts. So that is my safe attorney answer. My real personal answer that probably is going to be a bit more helpful is I think that you need to look at what we provided you here or what you might find in other resources, and you need to determine what you understand, and you need to look at what you understand so that you're able to make the determination that if you don't understand a particular aspect, if you don't understand a particular question and answer, you need to get that clarification. So for example, using just my own preparation for the webinar last week, looking at the statute, looking at the CARES Act rather, and going through it, I read it multiple times. I read that particular provision on the deductibility or the reduction rather of the amount that's forgivable under the PPP loan. I read that a number of times, and it was only once, only recently that I read it and it clicked in the interpretation of it as to what they were meaning. And as you remember, I said that today I said that it was not reducing it by the amount, but by the method. So you reduce the amount that's forgivable by doing this, not by the amount that you get by doing this. And just that nuance made all the difference in the world. And now it makes sense to me. And I'm someone that I love legislation. I love statutes. I love acts and diving into that. So if you look at something and it doesn't make sense, you don't understand it, then you've got to get assistance on that. But your short list of people that you want available is an attorney. You want an attorney to guide you on one, whether it's the PPP loan is applicable to you, for example, whether certain other things that we've talked about here today are applicable, and setting up particular programs, like setting up an employee policy or so forth. That's where the attorney comes in. A lot of the benefits under the CARES Act, however, are related to your taxes and accounting. And so you've got to have an accountant on board that knows this stuff, that has looked at it and is continuing to look at it. ideally, you're not going to be paying extra for somebody to their learning curve. So what I mean by that is that, you know, my accountant, I'm going to presume that my accountant has an understanding of the tax law as of the date that he's working on my taxes, or as of the date that I ask him something. He may not have the answer today, and he might say, I'll get back to you tomorrow. That's not the learning curve that I'm talking about. What I'm talking about is an accountant should not be charging you $2,000 to give you COVID-19 advice, in my mind. They should be having that knowledge and getting it. That's part of their profession. That's part of what they do. Likewise, for us, in terms of advising our clients and small businesses, I've gone the extra mile, I think, in that I don't think that I should be charging anybody for initial COVID-19 related advice. Now, obviously, when it gets into detail, drafting documents and so forth, that's different. So I digress. Let me get back to your question. The short list of people are an attorney and an accountant, and you should ask them whether or not they are familiar with, on one hand, CARES Act and the FFCRA and other COVID-19 related matters. And if they're not, then I would advise, at least for that aspect of it, that you find an attorney that is, so that you, again, are not paying for that attorney to get up to speed. If they say we're not, but we will be, and it's no cost to you, fine. But what you do want to do is find somebody that is immersed in this and has read it and understands it. Same thing with your accountant. Have those two related. The accountant is going to probably come down to when you file your taxes at the end of the year. The most urgent thing right now, in my mind, is if you have applied for the PPP loan, great. Be aware of the representations that you have made. And this is an attorney giving you this advice. There are certain representations under the CARES Act that you are making by applying for that loan. Be aware of what they are. And in fact, I think that we can work with the Alliance Collaborative to have that on a specific sheet, so that I'm sure that if you suffered any harm or anything related to COVID-19 aspects right now, it's not going to be a problem. But I think we should have those up there just so that you know. But, you know, the most immediate then beyond that is, how do you maximize your forgivability of the expenses? And if your accountant can help you with that now, great. If it needs to be the lawyer that guides you, that's fine too. I think that they can work hand in hand. And I think that, again, how do you know when you can make the decisions yourself? It really comes down to how much you feel comfortable with. If you have a grasp of it, if you understand the questions, then you might come up with the numbers and even run that by, send it in an email. It's going to be a lot more efficient, I think, sometimes for the lawyer or the accountant to get an email and maybe have somebody on their team that can confirm that or read through what your interpretation is and guide you one way or the other on that. I hope that that has been helpful in answering your question. I would say that, you know, using the most immediate need right now, I think, is that if you need to have the FFCRA poster up, for example, in your workplace. We've put it up in our workplace, even though nobody's there. We just went in, did it, it's up. We're doing that with complying with the law, but we're also complying with the intent of the law, and that is to give notice to our employees. So we emailed that out to our employees as well. Having those kind of provisions, having the paid leave, modifying an employee policy. Elsewhere, I've written an article on small businesses and law firms even kind of adapting to this remote only environment is changing the the employee manual, the employee policies. You know, look at that. That's another aspect that you should be considering. And those kind of things are working with yourself, doing that yourself, or consulting with an attorney more than the accountant. Again, as I said, a lot of the issues are tax related, but I guess I didn't answer what I was saying before. The most urgent thing that I think right now is, as people are starting to get, I saw an email from a colleague that he received notice from a bank that said that we're waiting on, the loan's been approved. We're waiting on funding instructions from the SBA. What does that mean? So as soon as that loan is originated, your 8-week period starts for forgivability. And so you need to be thinking about what you're going to do. How many employees are you going to bring back? Remember, it's a ratio of the average monthly employees that you have during that period of time compared to, and you can elect where you look at what particular aspect of time, because there's a special provision there for seasonal employers. But you want to maximize that. The goal of the PPP funds is to maintain or increase workforce. So who do we bring back? In what order do we bring back? Who's the most important to bring back first? If you're not going to be able to bring back everybody, what are you going to do? Or do you bring back everybody and you do so at 90% of their salary, right? As long as you have reduced their salary by no more than 25%, you shouldn't be penalized. Those are things that you need to be thinking about now, even before the funds come through, because you're going to need to be paying those funds that you get. If you're wanting to maximize the amount that's forgivable under the PPP, you need to have a plan for that. You need to be putting most of that toward payroll, and be using those 8 weeks in an efficient manner. Now, you can remember that you have until June 30th to add people back or raise their salaries up before you apply for the forgiveness. But the 8-week period is starting now. I don't know if I answered your question. I hope I did. But if I didn't, or if you want to clarify, or anybody else has any additional questions and clarifications that they want, COVID consults, COVID-19 consult.mudlaw.com. Still providing complimentary consultations for individuals on these issues. And I can give you a little bit more personal advice in that regard, complimentary. Are there any other questions? Not to end abruptly, but it is 1:02 and I don't see any additional questions. I really hope that everybody stays healthy, everybody stays safe, exercise, shelter in place, social distancing, physical distancing, because for a lot of people, I think we've become more social in certain respects than before. This past holiday, Easter Sunday was a holiday for us here. We Zoomed with large portions of our family, and my youngest son said, you know, this is something that we should do every year. So maybe, and I'm going to leave on this positive note, maybe that in all of this horror that many people in the world are going through and businesses are suffering hard times, maybe in the midst of all of this, there is some shed of light and some positive aspects that we'll take with us moving into the future. And on that, I'm going to end. I want to thank again the Alliance Collaborative. I want to thank everybody for participating today. Stay tuned for our next webinar on Thursday, kind of tying into what we just talked about here at the end. Now that we've got the loans down, now that we've got other provisions, you've lined up your accountant, you've lined up your attorney, you're ready to go on resources. How do we get back to a normalcy? Until then, be well and have a great day.